All right, so I've got an agenda here, and thanks for joining us on a not Tuesday. Today's Wednesday, and I'm going to try to make quick work of this. I know I said that a bunch of times, but I think there's so much to say, and at the same time, there's not that much to say. And I think that is primarily because the investment, the whole idea of investing now, and just thinking back to decades ago when I first started doing it professionally, it's gotten to the point now where if you're trying to find good companies to buy and hold on to them for a long period of time, and look at dividends and look at earnings, or okay, the internet was one disruptive force. And initially, it was a good force, and then it turned into something that kind of set a lot of people up for failure. Uh, and I'm happy to talk about that more if somebody doesn't know what I mean. Uh, and now we have it with AI. And it's gotten to the point where when everybody knows everything and they know it instantly, and frankly, these days you don't even know what's true and what's not. In a way, it's kind of refreshing that you can come back to the markets and you can decide that you want to just use the markets as a tool, just like I said for a long time. Use them as a tool to get what you want out of life, but specifically what you want to get out of the portfolio. And so a lot of what I have been doing, and I will pull up the threes report from yesterday. Let's see if we can find it. Published. Nope, not there. I'll I'll find it. Um, but the threes report yesterday was kind of me letting a lot out there. I'm going to try to make it a little bit longer, read than it has been, because of course we have two tiers now. We have the you folks and the other people now that pay for a I guess a junior version of this without the live discussions over on Substack, and they can. Uh, I want to make sure there's a lot in there from week to week, but at the same time, I was thinking about it today. The concepts like, oh, let me give you a research list. Okay, let me give you a bunch of ETFs. Some of the things I'll point this out as far as this actual the actual sheet that we share with you folks. But I am now getting more and more convinced by the day that uh, moves are too fleeting. Um, you either have to be a like long-term investor, or you have to be a trader. At least the way things are now, because the entire market, stock market, it was just basically an AI trade, and the only thing that will change that is uh, if uh, if if there is kind of water thrown on that idea. And about the only other thing might be something in the bond market, but there's nothing apparent right there. And at this point, um, I guess I don't want you to think for a second that I'm unhappy about this. I couldn't be more excited, because for the longest time I've tried to explain to anybody who would listen that modern markets are about buying and selling pressure because of algorithmic traders and indexing. I've seen the ETF thing 32 years from the first one when SPY came out in 1993, and I see what it's become now. And I'm telling you, in my strong opinion, people are spending a lot of time on things that do not matter. And the only reason that some of them they still think matter is because the markets have been buoyant. But at the end of the day, what is it about? It's about simplicity, it's about process, it's about technical analysis. That's about it. And I'm going to show that to you as soon as I go into the back here and pull up the threes report. There it is. Okay, good. So let's go back and do the share again. And there we go. Okay. So going to walk you through the threes report to start here. And I have these quick little notes here. So yeah, I'm trading more, and here's why. Okay. So I explained some of this yesterday. Hopefully you've had a chance to read it, because this normally comes out like right before we're together. You'll see again, you folks are getting the whole thing. A lot of people are just kind of getting like, a little bit of this and that's it. So, uh, we have to remember, when the markets do so well, that they are capable of falling apart very quickly. 1% in 100 minutes. If you do the math on top of that, you're talking about, I mean, how long would it take to drop 20%? Not very long. And there is so much froth built in. Again, I'm not complaining. Remember what I've been saying probably since most of you met me and started working with us. It's the most dangerous market I've seen in almost 40 years. And it is the most opportunistic market that I've ever seen. It's both. And that, to me, makes it so that the best thing that any self-directed investor can do at this point, unless we have a total washout and things go back to normal, whatever that may have been, is you kind of have to sort of pick your battles. Meaning, what are the things you really, really want to get good at? And that is really like straight from the heart. Trying to figure out how to do a little bit about, or trying to figure out a small portion, okay, of, or as they say, a mile wide or an inch deep. I think that's only going to hurt people's long-term performance. It's just too much of it. At the same time, it's the simplification of it. I mean, this is what I'm speaking about at the Money Show, I think a week from Friday, up in Orlando, giving an educational presentation there, which, by the way, I'm going to preview for you next Tuesday here. And it's all about making investing simple. So I think that we are truly at a moment here where the biggest mistake that a lot of do-it-yourself investors can make is feeling like they have to do too much. I think it's really, really streamlined. And to the extent that I come to believe that the club members believe, what I'm saying, agree with it, we'll keep doing what we've been doing, which is taking information out from the research deck and just putting it more into the threes report. Okay. In fact, if you have an opinion on that, if I said to you, hey, next week the threes report is gonna, it's gonna be a little bit longer, but it's maybe gonna have some highlights from this thing in it, so that you almost would never have to go here, because we do not know. When we were sharing the sheet with everybody, we knew exactly where people when people would be in. Okay. Saw somebody in there about an hour ago. All right. But since a lot of people are accessing it through Seeking Alpha, through the little hub they have here, we don't know how often people go in. We can't really track that too often, I don't think. So I'd like to know, are you still getting this, or would it be easier if we just try to make this available as part of, let's say, putting this out more regularly? We might do a second one every week where I just say, here, all the stuff that was sitting in here, okay, the stuff that is not evergreen, this type of stuff. If you would prefer that we just kind of put it all in here, maybe in a couple of segments during the week, kind of Rob's very best thinking, not just Rob's best thinking. That's kind of where our minds are going, because just information flow is it's too much. And what happens is, it's not garbage in, garbage out. It's the garbage crowds out the real nuggets that I think is are the keys. Okay. And that may be different depending on what you're trying to get out of what we're doing. Anyway, that's enough of a preamble. I mentioned this. Hopefully, you had a chance to read it. There's big difference between these crisis markets and the ones that everybody's used to. As somebody just said here, FOMO is unrelenting now. Absolutely. Okay. Good, David. I'd be curious to know what you what you get out of it the most, because it's not a matter of we don't want to maintain the spreadsheet, because of course I do. It's a matter of, do we need to do all that updating, or is it more almost like everything's a bit of a news flash, if you will, or a short summary of what's working, what's not, a little bit more like the ETF scanner, if you know what I mean. So anyway, I talked about risk management here. Yeah, this goes right with the FOMO comment. Okay, 98% of the time, people are in the industry are focusing on how much you can make and not what you can do to keep investing moving forward, but just make sure you don't get crushed at some point. So there was the thing on the NASDAQ. I thought this was actually pretty accurate. That's why I put it in here. This thing about trading hours, it's true to form much of the time. Okay, this really is kind of the key for this current week's issue. Okay? I am devoting a lot more time, but less capital, and I've got my current trading portfolio ready to show you if we want to spend a few minutes on that. So I'm doing a lot of shorter term stuff, because I hate to say it for those who are still kind of clinging to the idea that well, I feel great about owning I don't know, Verizon, because they have the best communications network, and they paid a dividend for so long, blah blah blah. And I feel like I want to interrupt with the scratching record. Like, wait a minute. Okay. We might all love to have the markets work that way, but like I always say, you have to work with the markets you have, not the ones you wish you had. So that's just the constant theme that's been running through since the last time we were together, and it intensifies every. And it's because I'm when you think about it, what I do now, I'm at the juxtaposition between the investment markets, technology, and communication through writing for a couple places, et cetera, and of course doing this and Substack. So I'm right. And so I'm really at the crossroads of all that stuff. And what I see is like the pace has picked up so much that unless you want to spend every week saying, oh, why was I flat-footed this week? How did I miss that? And I'm not saying you have to be a day trader. I'm just saying that in terms of what's the bottom line, okay? Let's take a proverbial $100,000. If I have $100,000 and I say, okay, I would like to grow it. Well, at the end of the day, it doesn't matter how I get there. The only thing I've ever been concerned with is, does the 100 go up to 101 and then 102 and 103? And yeah, it can go down a little bit, but if that 100 turns into 80, I have completely screwed up, not to mention screwed myself. And I used to have clients back in the advisory days. I did for a long time, and back in those days, we would try to present them with reporting, quarterly, monthly, whatever it was. And we talk about performance versus this and that, whatever. And I think even back then, people are like, well, I mean, I had 2 million when we got together at the beginning of the year. It's halfway through the year, and I have 2 million, 50,000. Okay, I'm good. I'm up 50K. Like they were mostly like that. And now I guess maybe I'm just getting older, but I'm like, no, it just move the pile forward, as they say in football. Okay, just keep moving the ball forward, and don't take any big negative plays. And so I think that too many people are trying to get style points now, between the jargon, between fancy strategies. Like I say, I do a lot of options work, ton of options work. I barely speak the Greek language when it comes to the option stuff. Right? So anyway, I think that that's really where my mind and my process, which to some extent is what you folks are kind of buying into here. Thank you. Um, that's where it's going. And frankly, it's kind of like every day you have to be ready for anything, but always be set up to avoid major loss. What is major loss? Is as you define it. And I'm going to touch on that before we're done today. Okay, so went through, just, I don't know. This is not a good look for me with the small caps. I don't know. Best case, they're going to tag along. I have not been a small cap fan in years. I also pointed out a couple of ETFs, this one, and the first thought I had was, oh, why clean energy when it seems like politically and all that, at least in this economy, they're trying to go the other way. It's because I think the market view at this point is that we're going to need every type of energy. Why? Because these great, AI builds are going to take so much freaking money and so much freaking power, uh, electric power and otherwise. We're going to need this. So, look, if you want to know my ultimate issue with AI, is that it's too undefined and too optimistic a story for it to not one day crash. I just don't know when the day is. So my whole strategy has been keep trying to make nickels and dimes very consistently, but there's no such thing as, oh, I'll have to figure out when I should start protecting. Okay. Because I think every day the odds get stronger that I guess it's time to play defense. Okay. We might wake up one day, 1 week, 1 month, and it'll all happen before most people can do anything. Oh, I'll just buy put options when the market looks weaker. And if the market opens down, limit down one day, 5%, 7%, whatever it is, VIX goes flying. So much for your options. Can't buy puts anymore. They're too expensive. Yeah, I've done it. Okay, I've learned that lesson. So, there's a lot that I wouldn't say it concerns me. I just know it's not going to go on forever. But so what? In the meantime, I'm probably more aggressive with a smaller amount of money than I've ever been in my investing career. Certainly when I was doing with clients. Uh, so anyway, like I said, most dangerous and most opportunistic. So you get a lot of things like this. And I pulled. I'm going to try if you guys think that it's going to it would be helpful. I'm trying to make this a little bit more like, hey, let me pull some things out from a little more from my trade list here. Okay. Um, that so. Um, we're going to move on. Here's the other one. Okay. Again, this is what I'm talking about. Like, there's a lot of things I see going on at the individual stock level, but they move too quickly. And so it's great that the artificial intelligence ETF is doing well, but like so much of the market, it just looks really toppy here. But look, I lived through late 99, early 2000. I got to go back and study that a bit again, and probably look back at what I wrote to people at that time of writing to the clients. So, uh, this we could have liftoff here in a bigger way than we've had before this is all over, or it could end tomorrow. All right. Walked through the top stocks. I mean, again, this also, uh, the mega caps, they there it's more likely you're going to see something that just looks like it's just going up steadily, as opposed to stuff like this. Like I'm reaching a little bit here, but okay, Visa looks pretty good. I see this. I see it's got room to here. I see this 20-day moving average in red has turned up. PPO same, going through zero here. These are all my usual looks. So at first glance, I say, okay, that's probably a 60 Roar score. It's got 60% chance of going up a lot before it goes down a lot. And then you have some things like this with the banks, because you have the Comerica deal, and now potentially they could all be in play. Uh, and this is a pretty good example of what is going on. Like I say, it's swing trading versus investing. Okay. So I don't mind telling you, I might have heard of this company, but I'm pretty sure I hadn't, like, I don't know, a few weeks ago. Uh, but I, let's see, I first bought it on September 10th. Like I said, I put $2,000 into it. Okay. And my thought was, okay, if I can make $200 on this, I just want to start in this trading account. And $100, $200, whatever. It was one of the better performers. It pulled back. I took some profits and then right back up. I think I've owned it 3 different times in the last 4 weeks, and every time just a little bit. And I see now why so many people, frankly, are sitting in front of their desks all day trading. Not something I want to do all day. I'll do it several days of the week, that type of thing, part of the day. But this is where the nickels and dimes are being made. And if it's not that, then you kind of have to take a step back and say, okay, uh, like you give me 20 stocks, and my guess is I would chart them and say 15 of them look alike. So it's only when you get down to, let's say, these lesser known, not brand name companies. I mean, they're in the right space and it's not a small company, but, in 99, 2000, we saw stuff like this, part of the infrastructure, where things are going. But, uh, a lot of these companies that all of a sudden it's like, hey, it's a legitimate company. It's 7 billion in market cap. Great. It's 7 billion in market cap now. It probably was a billion in market cap a few years ago, and it will probably be a billion in market cap again, but I don't know when. So what I'm saying is, if it makes it sound like it's a casino, it's because it's a casino. And the thing you have to ask yourself is, do you want to work with a casino? I've been doing it long enough, so it's second nature for me, and I try to teach it as fast as I can and as simply as I can. But that whole thing, it's like, okay, you do you want to be that active? If you don't want to be that active, then you have to take a step back and say, okay, I'm still going to play offense and defense at the same time. One way to, well, like for instance, the way I'm playing offense right now is a lot of this short-term stuff. How am I playing defense? My bond ladder is the biggest part of my portfolio by a pretty decent margin. Second biggest part of my portfolio, spy collar, and eventually, as I've alluded to, I might flip that over to a Q's collar, but same general idea. So a bond ladder and a collar, okay, and a lot of swing trading with smaller amounts of money. And so to me, um, it's quite an adjustment. It's one I've done before, and I've always been willing to. But this is very different for those of you who remember, like I used to run something for the clients and then I kind of carried it over for years and a year. The core ETF portfolio. It's great if you can have a portfolio where you just take ETFs and you buy and you sell. You're seeing it already in the one active portfolio that I show you with the collar and everything, all the stuff around it. I mean, I can't even get the ideas out fast enough. So let me start to put some context to that and go back over to here. I know there's some questions, so I'll get to those shortly. I'm just going to cover a couple of these here. So here, this is what I was just saying. They move too fast for even this. That was what I want to remind myself to say. So where is Rob's active model? Okay, so you click on Rob's active model. Love how that works. The collar is still the collar. Just show, okay, it's here. Actually, it's not a collar anymore. It's just put options. All right, I sold the calls. And by the way, in retrospect, probably a pretty good thing I did, because I think I probably would be in call range at this point, and this only has a couple months left. So, look, at some point I might have to move the 650s up. I don't know. Okay. But the rest of this, okay, it's a much smaller amount. Yeah, I've got. Remember, it doesn't show the collar. It doesn't show the options here. So I've got this big position, and then it's got a few others around the sides. But honestly, it's like, it's great that they're doing. Some of them are I don't know, flat to slightly up, but there's not much distinguishing one from the other. Like, I would put it this way: I would be better off if I were looking at J.P. Morgan Chase and Exxon Mobil and iGov and this Fallen Angel high yield ETF, and Govy, which is 1 to 30-year laddered treasuries, not like I ladder the treasuries because those are zero coupons. This is an ETF that just buys coupon treasuries 1 to 30 years in equal amounts. But all these, I mean, there's risk of major loss on the table higher than there normally is, for not for these in particular, but for everything. And at the same time, it is so much more likely that I see that you're going to make 5 or 10% or so, maybe up to 20% in a matter of weeks, maybe even days if you're dealing with the smaller stuff. That is much more likely than saying, hey, I buy it here, and a year from now, I made 10%. And if I can do that across the board, I'm making 10% a year. That was the old way. Maybe it will come back, but I am not holding my breath. And so I have adapted my own approach to have a lot of that defense I don't have to think about. I don't think about my bond ladder very often unless interest rates are really changing, and maybe I'll want to do something opportunistic, but I don't worry about it. I don't sweat it. And the collar, same thing. What's the worst thing that can happen? If it goes down, I have a put. If it goes up and I get called, or I'm in danger of getting called, high class problem, right? RPP, as some people say. All right. So that's why this portfolio, and I'd like to hear from you, because the way we normally work things around here is I say, I would love to run something like this. I'd love to run a bunch of portfolios. I'd show you all kinds of stuff that I'm doing. But even with it being tracked live like this or on a 1 day basis, nothing sits still long enough. It either moves this way or it moves this way. There is not a lot of just like this. That's what the collar helps to do, or the options to put options, married put, and that is what the bond ladder does. So, I hope this is coming across in the positive sentiment that it is intended to be. All right, so let's go back to I wanted to make sure I covered that. Okay, the weekly ETF scanner. All right, and this is what I'm talking about. It's really difficult to find very high ROR scores. And I'm trying to figure out how we can have, I don't know if it's a sped up model or what, okay? But this ETF scanner, I'm always looking at what we provide in terms of content and seeing, okay, is it good enough? Is it helping? And that's why, the more feedback we get, the better. The less feedback we get, I kind of take matters in my own hands and say, okay, we're not offering this anymore. And rarely do I hear from anybody that, oh, why did you take this away? Whatever. So if there's something we're doing that you really like, other than live sessions and the threes report, just let me know. And if you're listening to this on the recording, put it in the chat or info@sungardeninvestment.com, whatever, find us. And because, like I said, things are moving too quickly. All right. The ROR score, that part's easy. Okay. It's going beyond that. It's when you're starting to look into it at this level. I used to be able to run ETF portfolios, not just SPY bill, but a little more like, this is the closest thing to my core portfolio, where I'd say, okay, here are my main offensive weapons and my main defensive weapons. And I would use the sectors. I might have some other interesting ones over here that I think are unique. And I would run a portfolio of ETFs that would look something like this. Now, back in the client days, they would all just appear in their regular, Schwab statement. But but in my mind, I'm thinking, okay, I've got a core equity position, top 20 stocks. They're outperforming. They're continuing to outperform. Okay, had Japan in there. Well, Japan did really well. But guess what? The 2 month to 3 month window to make money on Japan is probably already up. If I can remember all okay, this has got a lot of energy in it. It's also got some gold and silver in it. Okay, great. But the problem is the moves happen too fast. That's the problem. Okay. And that's why having a little bit of this in here. I actually heard somebody, an investment manager on CNBC today, like a client advisor, and he's one of the ones, in addition to myself, that made the point to say, you can be more aggressive if you just have some put options out a few months, on the market. Like, yeah, couldn't agree more. Okay. So, but putting this together and the rotation and all that, the problem is that even trying to do this on every Tuesday, I trade it, it's already moving too quickly. And that's because of the nature of the market. It's go or it's no. So there's not much in between. And when it's like that and things correlate so much, where do I find value? I find it in swing trades on a combination of stocks, and a combination of stocks that even I hadn't heard of. But it's not about the stock selection. It's about the process. It's about the repeatable process, which to me is charting, technical analysis, but it's my version of it. And that's what I'm trying to I wouldn't say spoon feed. I'm trying to fire hose it out to folks as quickly and as easily as I can and as simply as I can. Okay, so let's see. Anything else to comment on from here? I did want to go to the ETF scanner. Again, this would be a prime candidate for us to just put in the threes report every week. So the more people say, oh, yeah, that would make it so much easier, one less thing to do, okay. Um, and probably would have a little more, I don't know, discussion or some more charts on this. I try to make it so that we're just covering the biggies here. Okay, that doesn't give you a lot of the nuance stuff, but as you can see, at the broad level, what you have is a collection of things that if they're 50s or 40s, well, if they're 40s, it means they've gone up. Small caps have done pretty well. I don't like them from here versus the rest of the market, but they've done pretty well. So they are going to be graded as stretched, above average risk. Same with gold, more by the day. Okay. But so same type of thing. All the others, they're just kind of neutral. So there's kind of a way of saying that uh, markets are pretty copacetic or very stretched. And if you want to try to find alpha, so to speak, well, look at where I'm looking. Okay, natural gas, which, by the way, is one of my least favorite things to even put on a upwardly mobile list. Down 5% today, up 5% yesterday. I still think the intermediate term pattern probably a little bit better, but still, I'm not gonna. This is perfect for taking a small position in or using leverage or something. Okay. Just a couple others here. Utilities are part of that same story with the with AI kind of sucking up all the air in the room, right? The electricity providers, and you can see, and this is the part that to me I start to be concerned that I'm just giving you too much garbage. It's never the intention, but okay, some of these were in there for a week or two. Well, they're gone already. Why? Because they did go up in most cases. So, but that's it. They're moving too quickly. And I can show you some of the charts on these if there are questions about this. And the same way, the gold and all that stuff, the silver, especially the miners are getting a little bit too juicy. And let's see. Yeah, and a couple. Here I'm going to pick out a couple of these charts here before I'm done. I'll do all the charting at once. Okay, and let's see. Top 20 stocks. I will point your attention to the fact that this mix changed just a little bit. Had a couple that came in. Obviously, Oracle with a huge move that ended up in there. AbbVie, same type of thing, but and this was done, I don't know, day and a half ago. Already seeing a little bit of movement, but I'll just tell you, it is such a market dominated by day traders, algorithms, um, and indexes that trying to find fundamental value or anything close to it, yeah, not for me, not for me. So there was Microsoft, there was Visa, which looked not bad. A couple of others are starting to show some signs, but honestly, it took place like just in the last probably 24 hours. So that's what I'm saying. Trying to find what you want to spend time on um, is really the big decision right now, because there's a lot of candy out there, if you will. There's a ton of ways to make money, but you kind of have to pick one or two and go for it. Okay. Last thing I'll just mention here. Um, I am kind of, it's funny, I was thinking this was 7,000, but no. So here we are, okay? We hit 4,800, and of course, if it wasn't for Liberation Day, and I'm not big into predictions, but if you want to look at how the charts can really help you over more than everything I've been talking about today, which is more of like a swing trader's time frame, uh, then you this I think is a pretty decent thing. I mean, nothing's really changed here. In fact, maybe I'll devote a session to this, but like nothing's changed other than the fact that the top 10 stocks I think are now 41% of the S&P 500. Um, I mean, this snapshot is probably, like I said, published in late 2024. Like not a darn thing I think has really changed. Okay, high risk, high reward continues. Not a time to blow off the risks. Okay, offense and defense at the same time. And but for a post Liberation Day announcement, I think it was on April 9th, my late parents' anniversary, ironically. We might have hit 4,000, and here we are on knocking on the door of 6,800. I'm not usually that accurate, but the point is the fact that I could see that there was likely to be a wide range from top to bottom, wider than normal, um, was something that the charts were saying to me, you never know for sure, but there's a higher probability of this. Okay. And we have to just deal with probabilities right now. Okay. So the only two things left here are going to, and thank you for all the stuff in the chat. Let's see, you guys can't see the chat, I'm pretty sure. You can see it yourselves, but let me just see here. Okay. All right, visit the sheet once or twice a week. I'll get to the charts at the end here. Okay, yeah, about twice a week, a market pulse, or hey, I'm noticing this. Yeah, Chris Larson, thank you. That you put into words what I couldn't. It's the format. Honestly, if you folks and anybody else listening on the recording after this, after Wednesday when we're recording it, this is what I need. This is what the one thing I really need from you is try to describe the format. You could even send me something here. I took a picture of this and I put it in the chat or whatever. Okay, or just email it to us. But delivering it in the format, because it's not like I'm not doing this all day. I am doing it all day. It's just a matter of toughest things for me as an investment group leader, leading an investing group, which is not just like a slow go, buy high yield stocks and hope that, rates don't go up or there's a credit crisis or whatever. Okay. High yield stocks and bonds. And I know a lot of that is popular. More power to them if any of that stuff happens. We're here to try to teach risk management and how to teach constructing a portfolio, even if it's not, well, I'm this much in stocks and this much in bonds, right? What did I say before? I have a bond ladder. Well, there's no ETF for my bond ladder. There's no ETF really for a flexibly run collar on SPY or Qs. And the only thing that I would say is sort of modelable of what I'm doing with my own funds for the most part now is the trading stuff. And so I'm trying to give you the evolution of my thought here as the years gone on. I didn't invent any of this. I'm just trying to read the room not being this room, but the markets. This is the nature of the markets right now, and I think we have to stay in sync. Okay, let's see what else we have. Okay, let's see. So I love that idea of a pulse. Let me see. I could never commit to a everyday thing, but could I do here's a few things I'm looking at and say, I'm probably going to do it 3 times a week, maybe 4, maybe 5 occasionally, and I don't know exactly when. I'm pretty regimented about a lot of things, so I like to be like, okay, Monday I'm doing this, Wednesday I'm doing this. But if folks are like, hey, you know what, if we get the threes report and a couple other little, pop outs from you, almost like a on the fly version of the three report, pop in a chart, whatever, do this. If that makes people happy and it takes you less time, then we have something. But again, I don't want to put words in your mouth. So let's see. Okay, mainstay of my business. Yeah, ETF model portfolio tab. Okay, ETF scanner and checking for changes to the active model so you can comfortable. Okay, got it. Yep. The good news on that is it's not going to be right away, but I'm really trying to convert this. Okay, this will probably be almost like its own ebook. Uh, and that could really help. Okay. Um, and yeah, as far as the scanner, it doesn't have to be this formal. I could simply say here, if I see something that reminds me of an 80 or a 70, and you want to know about it, but the problem with that is they change so quickly now, and it's not me changing my mind so quickly. It's that everything just moves or it doesn't move. It moves in one direction or the other, and there's no steadiness to any of this right now. So, like I said, opportunistic but also dangerous. Okay, let's see. All right, SQQQ collar. Yep. Okay. Probably requires a little more maintenance. Let's see. All right, trying to understand what you're looking for in the charts, recognizing patterns now. Yep. Okay. Let's see. The swing is behind us with new highs. Yep. Okay. I'm just processing these questions. I came across a fairly new indicator, MACD-V. Really? Okay. I'll write it down. Come back to it. I don't use volume. I don't know what the V is for volume, but kind of using a screener to find your top 20 stocks. Top 20 stocks? No, the top 20 stocks they're not like my favorite 20. They are literally the 20 largest stocks in the S&P 500, because we have reached a point in this historic market cycle where these 20 stocks make up nearly half of the entire S&P 500. Think about that. The other 480, if it were a tug of war, okay, it would be close. And that's what I mean when I say indexation is what's doing this. If a ton of money goes into index funds, and now I'll kind of pivot over to the charts, but there's a ton of money in the index funds. That is probably what lifts a lot of the boats in, like pick one of the top 20. They probably all get a little bit of a lift, other things being equal, anytime there's just a flood of money into the index, and that's what's happening. This is, matter of fact, I said it's one of my editors today. I can't remember what the others were, but it's liquidity, technicals, and I can't remember what the other one was, but it's spelled lit, and I'll be writing an article. So. But that's it. It's like I say, it's like all this stuff that's going on. Okay, boy, can I show you a lot of stocks that are not moving any way whatsoever in sync with what Wall Street thinks of them, what analysts at SA or anywhere else think of them. So much of this doesn't matter. I mean, look, Nvidia's had an F valuation forever. Okay, it just keeps going up. The reasons that prices are going up and down in the stock market, not in the bond market. Bond market is still run the way it has for the most part. A little more skittish, but the stock market at this point all liquidity driven. It's buying pressure and selling pressure. That's all it is. Okay, so let's get on a few of these, and just to tease you a little bit here, okay? This is I just dropped this in from my account at the end of the day. If you'd like a quick tour of the trading portfolio where you can see just, I can use it really as a watch list to say, hey, this is what I see in this chart. This is what I see in this chart. Okay. Let me see. Swing trading. Wait, your swing trading is likely, not in the top 20. The funny thing is, is a great question because I'm still defining that. Okay. I don't want to it probably would take a whole session or a special session, but I can show you. I'm happy to show you what I do going to bar chart. Um, but I haven't honed it just yet. It's more of a throw it against the wall and see what sticks. But I look at the Dow 30. I look at the top 20. I look at the entire S&P 500 at least once a week. I'm going to try to look at the next 500 largest once a week. I look at country ETFs, did that a little bit today, not a whole lot there. So I haven't seen anything in the country tab. I look at a ton of ETFs. And sometimes I'm looking at the ETFs to say, hey, wait a minute. Like the ARTI that I showed you before. I'll show you what's in ARTI, and I'll show you what I'm doing next. Anyway, somebody asked about this. Okay. So look, even if I did know this company's business inside out, maybe it would have helped me, but then something else can come along. Okay. Uh, what I saw here, just so you know, it's the same thing over and over and over again. But you have to understand on the technicals, it's not even close to a 100%. Like I would say maybe I've honed it to 2 out of 3. I'd say between 65, 80% accuracy. Or okay, to the point. And you know what? Let me save my thunder, okay? Because I just want to show you what I'm seeing in the chart. Okay. There's a few things that I look at, and part of it is kind of mechanical, okay? And I actually have somebody that is trying to take the Roar score and try to make it so that it is just about fully automated if we want it to be. I think next week he's going to give me kind of the updated results. So anyway, when I see the 20-day moving average, that's the first sign. But you also have to look at the chart. Okay, if the 20-day moving average started to roll from negative to positive because the stock went up 20% in a day, well, that kind of negates it. All right, and I could probably show you a couple of those. So that's the 20-day moving average. That's the 50-day moving average. I look at that too. But it started the 20, just laws of math. The 20's got to turn up, and then eventually this might too. And that's where I start to get interested. Okay, the PPO. Down here, but look, you can get shaken out a lot too, so you have to have a plan going in. And one of the things I'm probably going to do once I am done with the I'm sorry, with the ebook, which covers everything I've tried to use and teach for 30 years, I will probably move on to talking more about this stuff. And I am really trying to put it all into a box or a bottle for people. The faster, the better. Okay. Um, this was, I guess, yeah, I think it was September 10th, something like that. I mean, obviously, I just started doing this here, but I saw this starting to move, and look, after a while, it's just pattern recognition. Was this around the time it made a new high? I'm guessing. Yep, exactly. That's also part of it. Okay. The chart, if you look at the crosshatch here and look to the left and down, this is what I was looking at on the 10th. And I said, okay, I'll take a shot here. Also came up on a screen as one of the bar chart screeners. The system is so good. By the way, if you do decide to sign up for bar chart, I think we make a few nickels if you do, if you were not a subscriber, and you'll get a nice discount. So Dana has the code, or it's probably in the spreadsheet, but just ask us. I mean, cannot believe how little they charge for it, but whatever. So that's what I saw. And so I got this move. And then because I'm a chicken blank investor, as I like to say, I want to do, it's like, oh, look at this. Okay, I made a couple $100 on whatever, 2000 or something. Okay, fine, wait. And then guess what? It was just the pause that refreshes, just like it's been every other way. I don't know when this is going to end. Okay. And it's not just what you buy, it's the position sizing, you know. $2,000. The account I have is at 100 something thousand in it. $2,000, great. If it goes up to a little bit, well, maybe I cut it back a little bit. Maybe I sit on the sideline. You know, it's like trying to get the best team on the field. That's the analogy I've used for decades, and I use it in a portfolio context with with like ETFs. What's the best team to have on the field at any one time? And then there's, a depth chart. Okay. These are the starting players right now. These folks are on the bench. These guys are in the minor league system. Think baseball, AAA. These are the AAA and AA guys trying to break their way in. Maybe they are in for a little while. Maybe they get dropped down. Okay. If a stock, if Hut 8 were up here and starting to roll over, and I owned it, I probably would, kick it to the minor leagues and not just put it on the bench, if you know what I mean. Okay. And it doesn't mean that you have to do this with a zillion securities like I'm doing right now. I'm trying to bring this down and see, how much overlap there is. How do I really need that many? I know this. I'm finding so much stuff underneath. And you know why people aren't talking about this? Because they're not big players in the indexes. Remember, there's 20 stocks that make up almost half the S&P 500, and the S&P is, I don't know what percent of the total U.S. market, but it's pretty big. So it's just there's no room for anybody else. Okay. Also, it's a 3-day chart. Use a weekly, etc. I guess what I'm saying is you literally could do this all day long with the Qs or the SPY. Okay, I don't mean all day long. I mean just trading SPY. I make it to the point where I say, you know what? I'm just going to take this same mechanism and I'm going to use the Qs and I'm going to use the 10 or 15 biggest stocks in the Qs. That's my watch list, right? For some of you, this will be review. You decide what you're willing to own at a price. Right now, my watch list is very fluid because I'm trying to see. Okay, I've never devoted this much time to it. I've always, but the technicals, they work the same way in different time frames. They're just more accurate when you look at, let's say, a weekly or a monthly, maybe not a monthly, but a weekly time frame or a 3-day. Okay, so anyway, that's that. Let me see. Don, if you're not careful, you're gonna outdo me for most football references in a single broadcast. Be careful. Let me see. I could write an entire book about sports, but definitely football related to investing. Even just football alone, baseball alone, and horse racing alone. Those are the 3. So anyway, let's see. Yep. Okay, good. You got it. All right. So I want to see if I can do like a little double screen here because I don't need both charts per se. All right. Keep in mind, most of these positions are owned for very small amounts, for very small periods. What I'm doing right now is I'm trying to develop, albeit a short-term track record with this stuff to prove to myself, and then anybody else who wants to see it, like I was looking at it and it was like, okay, so far, granted, I started about 4 weeks ago, but in the month of October so far, I don't know, 65% winning trades or something like that. Okay, I'm probably going to get one of these things that just takes your trades in and it gives you all this stuff. And again, I'm not saying it's always going to be swing trading. I'm just trying to figure out, put in the work now to figure out. It's just another application of the technicals. I could sit here and say, you know what? I'm only going to use weekly chart patterns now, not dailies. And so, guess what? You're not going to get that many signals. You're going to have more wiggle room. A stock may go down 5, maybe even 10% and not break the pattern. Okay. But so that's what I'm saying. This is very personalizable. Okay. So let's see. Well, you probably know a lot of these. I'm just going to hide this so we get more columns here. Um, I mean, some of these just went in today. I think the Alcoa. But let me put this on here so we can sort them. Let's see where. Just filter this out. And this will be the last thing we do, unless there are other questions. Okay, how far out does a guy have to go to get the, oh, that's right. Okay. All right, and filter. And this should make it a little easier. And okay, so here, let's do this now. I'm going to show you the whole list and let's make this audience participation, okay? If there is a ticker let's pick, I don't know, 5 tickers, okay? 5 tickers out of this list. And again, here, let me show you a couple of things about this, okay? Yeah, so there's 140 in the account, okay? I mean, yeah, I've got accounts of different sizes all over the place, and this one just happened to be got plenty of cash in there. I still own a bit of the bill, but let me get to the stock here. Okay, so all right, Microsoft is in there. That's a pretty big company. Okay, all right, and then this one, UNH just went in. It's showing signs. Would I buy it in Rob's active model? I don't know. I'm not sure I trust it that much. Would I buy it in a swing trade? Yes, already did. That's 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 what's going through my brain with this stuff. Okay, Visa, like I'm willing to take a shot. Okay, why? Because I'm spreading the money way more than I would. Okay, well, I've got 40 names in here right now. Okay, um, all right, because this is not a portfolio. This is a list of charts I like. That's exactly what this is. It just so happens that my personal belief is that, at least for me, I'm not going to analyze it the same way unless I have at least some token amount of capital in it. And obviously, look, I mean, not small amounts of money, but what I'm saying, but how much am I risking? I mean, if you have $5,000 in something and it goes down 10% overnight, it's $500. Okay, it's real money, but probably not going to change too many of our lives. So that's my point. Okay. I will put in for some of these. Okay. I don't know exactly what CRISPR therapeutics. I mean, I heard of the company. Can't tell you what they do. Okay. But hey, I'm game for $1,000 investment. Okay. The gold thing. I'm surprised nobody they didn't have 5 questions on gold today. But I have been using gold either in call option form, although I find this is a lot purer. You don't have to worry with the expiration, whatever. So think of it this way. Yes, I own, I don't know, gold GLD calls somewhere, and I just keep rolling them higher. Every time gold goes higher. But I thought, okay, for this, I don't even have options approval on this account because I didn't want to tempt myself. So uh, the NUGT, I've used it a little bit before in small size. It is 3 times the gold. I'm sorry, 2 times the gold miners. Okay. Um, and I thought, okay, you know what? It looks good enough. Obviously, it's so freaking extended. Okay. It's based on GDX. Okay. It is extended. In fact, it's probably going to come down, but I am so tired of seeing these things get stuck up here. See, this would normally be a PPL to say, yeah, my dad taught me this a long, long, long time ago. He said it gets pinned up here. Okay. It can't escape because look, if the this is the difference. Okay. The charts help us really speak the market's language. Is that overvalued? I would argue it is overvalued. Great. It was overvalued at 69. Now it's $10 higher. Overvalued is not the same thing as ready to fall. This is what, to translate it back to the Roar score, stretched. So if you ask me, what's the Roar score of this? It's about a 40, about a 40% chance it will keep going. It keeps breaking the odds. That's fine. That's fine. You can go to the racetrack and 3 races in a row, a 15-to-1 shot can win the race. It doesn't happen that often. Okay. So yeah, that's the type of thing you see there. I'll just go through some of these. Okay, just show you what else. All right, I've got look. I can't help it. I play defense with everything. Okay, so I've got Vixie in here as my because if we wake up tomorrow morning and the VIX has gone from 17 to 35 by midday, this thing's going to go. This is going to make up for a lot of losses. So this is almost like my put option. Okay, there's even UVXY, which is 2 times that or 1.5 times that. Okay, Cat is in there. Used to be a Dow stock. Used to be a Dow stock. Okay, it's a wide variety of things. Yeah, you get some of these tech things in here. Okay, what I'm doing right now is I'm trying to speed read my way through this. China looks a little bit toppy. Okay, and I did make a little bit on FXY, but it's this is the main China ETF. It's starting to look a little bit tired. So here's Yang. This is not so much based on the chart of Yang. It's based on the chart of the other stuff here, like this one. And I say, okay, if that looks like it might roll over, and it's early, but after that long run, who knows? I wanted to mention this because here, okay, great. One in the Rob's active portfolio, this is the problem. And I've talked about Japan, so I wanted to make sure I brought up before we were done. So here's Japan, and okay, great. It finally had its move. All right. And there's a lot of stocks and ETFs that have gone through this year. 72, all the way down to 60. Actually, better than a lot of the market, the U.S. market. Okay. A brief period here where it was only moving up and down in maybe a 5% range. And then when you get runs like this, it moves too fast. My hope was that I'd be able to buy Japan and maybe 6 months to a year from now, sell it up here. I didn't buy it. I probably bought it in here somewhere because I had just started that portfolio. But that's the problem. The moves happen way too quickly, or they they go slip sliding away on the other end. So this is the situation that we have. I'm trying to think of another one where I say, okay, that's the end of that. Yeah, this was one that I had in that trading portfolio, travel tech companies, and but just as quickly as it, I mean, look at this move. This is since August. Okay, it's a 10% move, and then it's over. It's almost like there's an algorithm out there that controls a ridiculous amount of money saying buy until hits 10%, then sell. look no further than the S&P 500. Okay, the S&P 500. I'm trying to remember which time. I guess it was right here. Yeah. Okay. You know, the 20% down line is like here, here, and that's where it moved to. Why? Because apparently some algorithms were probably trying to get ahead. Yes, there was news, et cetera, but this is the type of thing I see as a longtime chartist. I see it all the time. The machines are in control, and we don't even have full AI yet. So, all right. Anyway, I love feedback. It doesn't have to be now, but I'd love to get some feedback because I try to cover a wide swath of things today. See if there's anything that I left out. We'll be back to Tuesdays. Okay, talked about this. Talked about the ebooks. I think we're done. Any other questions? All right. Enjoy. See you next week.